What's going on, guys? Welcome back to the channel. Matthew Muniz here. We have three passions: family, fitness, and finance. And in today's video, we're going to talk about what used to be my favorite dividend ETF, SPHD. I used to love it because of the high monthly dividends, but as of late, it seems to be decreasing in terms of the dividends. We're seeing some price depreciation. So is it still a buy in 2021? We're going to find out in the video. So if you're like me and you absolutely love monthly passive income, make sure you hit the like button, subscribe for weekly content. I release videos every Thursday at 3:15 p.m. Eastern Time. Now, quick disclaimer before we go into the video. I am not a financial advisor. This video is only my opinions, and I'm not actually telling you to make any buys or telling you what's going to happen. We can look at historical information and see past results. However, that does not guarantee future results. So keep that in mind. Now let's get into the video. Okay, so first things first, what exactly is SPHD? Well, SPHD is a dividend ETF that prides itself on having high dividends and claims low volatility. Now, we're going to get into that a little bit later. The great thing about SPHD is that it does pay out monthly dividends. So for all the shares of SPHD you're holding, as long as you have it a day before the ex-dividend date, you're going to get paid the dividend at the end of the month. Now, you do have to remember that those dividends are taxable. So when it comes to SPHD, SPHD has around 50 holdings, and it gets those from the S&P 500, and it chooses the highest dividend yield, yet the least volatile. And it takes the previous 12 months trailing to determine which funds had the highest dividend. When we look at some of the sectors that this fund holds, we have a lot of utilities, financials, energy, and then we start getting into lower sectors such as technology, healthcare. The reason that tech is so much lower is generally technology companies do not pay high dividends. That's not always the case, but the reason for that is oftentimes they reinvest their profits into growing the business. Now, the cool thing about SPHD is it actually rebalances twice a year, so once in January and once in July. It doesn't allow a single sector to hold over 25% of the fund, and that helps with the actual fund's diversification. You do have a 0.30% expense ratio, which is pretty average, but definitely not on the lowest end. The reason for the expense ratio is you do have to pay for the service of having all of these funds picked out for you and the rebalancing in January and July that we talked about. So it does say tax on distributions or qualified dividends, but one thing to remember is in order for it to be qualified dividends, you do have to meet certain criteria, and not all of your distributions will be qualified dividends, especially because the fund rebalances. Now, one thing to remember is you could always look at all of the holdings of SPHD and you could purchase them yourself and balance them into certain percents to mimic this ETF. However, you'd have to do that twice a year, and that's the reason that you actually pay that expense ratio. So once again, with the 0.3%, if you had invested $10,000, you'd be paying $30 in a fee in order to have this fund. So when we look at the history of this ETF, we have a little bit less than 10 years to go off of, but that's a pretty good amount of information when we want to start forecasting out the future going off history. Now, one thing to remember is past results do not guarantee future results. However, we can still use them to help us determine if this is a good buy for the future. The fund started off around $25 a share, and it did get to an all-time high of around $46 a share. It has decreased recently, and we're going to talk about that a little bit later in the video. What I do want to look at is this massive dip right here. Now, this is from the COVID recession back in March of 2020. So even with that, year over year, we've had around a 6% gain of capital appreciation. Now, that does not include your dividend that you get on a monthly basis, and yearly, it's generally been around 3.5%. But just in price appreciation, an average of 6% a year is pretty solid. So in March of 2020, we went from $39 a share all the way down to $28 a share. We have a decrease of around 30%, which is pretty significant. So even though the fund's name says low volatility, we still do follow the market. And if there is a recession or a market crash, this ETF is likely to crash as well. It does not protect you from that. So just keep that in mind. However, it only took us around a year to hit a brand new all-time high later on, and we're back in business. Now, I do want to point out two things. One is that the price does seem to be dipping recently. So we were at our all-time high of a little over 46, and we're dropping down. And actually, just a couple days ago, we were in the 42s. We are back up to 43, but what's more important than that, because we did see the dips in the history, is the actual dividend yield. So if we go to our dividend yield, which I believe is this tab, no, this tab. So we look at our dividend yield here, back in December of 2020, we were getting 15 cents, and then January 14, 14, 14, 12, 11, 12, and they just announced another 11-cent dividend. So when we look at these, we were at 15 for a long time, and then all of a sudden it's starting to go back down. So when we see dividends that are decreasing, that's not a good sign. Now, potentially after the rebalance, maybe this will go back up, and hopefully it does. But that is just one thing we want to keep in mind. And if you ever want to look at the history of a dividend, you can go to Yahoo Finance and type in whatever ticker symbol you want, whether it's an ETF or a stock, and you can look at the history. It's a pretty awesome tool that is free to use. So now let's look at a theoretical example. If we had $10,000 the day we started, so let's just say we had some savings and we decided to put it all into SPHD in one lump sum. We're going to take an average of 6% return. We're going to use the historical value to forecast out our next 10 years. And every year, we're going to contribute $500 per month. So let's look at what we'd end up with. So with this, we'd end up with $100,000 and we would have contributed $60,000. So that's not that significant in terms of interest when it comes to, if you had invested in Dogecoin at the beginning of January 2021. However, for a safer option, these dividend ETFs like SPHD are pretty fantastic. The cool thing about this is you did have the price appreciation to bring you up to $100,000, but what does that really mean? So what I have is, we're going to go to my little planner here. So if we had that $100,000 10 years in, and we're still getting around a 3.5% dividend yield, obviously it's not 3.5% per month, it's per year, but at the end of the year, we'd get $3,500, and monthly, our payments would have been just under $300 a month. So just for investing in something, you're getting paid at the end of the month, which is awesome. Now, an example, if we wanted to receive $500 per month, we'd need to have $175,000 invested, still get that dividend yield, and your yearly dividends would be around $6,100 and $500 per month. So with $175,000 invested in SPHD, you could be getting a payout of $500 a month without touching your nest egg, which is awesome. So now that we've talked about SPHD, we talked about what it is, we talked about the historical performance, the risks associated with it during a recession, and potential future performance, how does this fit into my personal plans or my family's plans in terms of investing? Well, this is not part of my retirement strategy. This is part of a goal for me to invest for the next 10 years, and then potentially I will inflate my lifestyle a little bit. For retirement, we have our 401ks, our Roth IRAs. Those are completely separate from this goal. This goal for me is to diversify my portfolio. So SPHD is one of the dividend ETFs that I hold, and I follow the dollar cost averaging strategy. So every single month, I put more money into SPHD along with other dividend ETFs such as SCHD. I invest in VYM, I have NUSI, I have Q Yield. I do have a video on those as well. I do all those things to have a diversified portfolio, and that's only half. My other half is actually growth ETFs. I like to have part growth and part dividends because I want to grow my nest egg for the next 10 years, dollar cost averaging it every month. Doesn't matter if the price goes down, if the dividends go down, any of that, because I believe in the long run it's going to go up, and 10 years from now we can start taking some of our dividends from our dividend ETFs and we can inflate our lifestyle. Maybe we'll take the dividends and use them for vacation. Maybe we'll reinvest them. Who knows what we're going to do? But for us, for the next 10 years, this is the strategy for us. So in summary, when it comes to SPHD specifically, even though I'm not a financial advisor, I do think it's a fantastic investment. I think it takes minimal effort if you follow the dollar cost averaging strategy, and you're just going to continue to get more and more dividends every single month. The snowball method is a beautiful thing. So if you haven't already started investing, you can use a brokerage such as Robinhood. I do have a link down below. You get a free stock. I get a free stock. Everybody wins. And to wrap up this video, if you found anything useful, comment down below. Let me know what you think. Make sure you already hit the like button, subscribe, and I hope to see you next week on Thursday for another video. Thank you so much. Take care, guys.